In the past, lords and ladies constructed castles and dug deep moats around them to keep invaders away from their wealth and well-being. Fortunately, people nowadays do not have to worry about their lives as much as they did in the past, but businesses still do. Companies in a capitalist society have to deal with a lot of competition. If you find a profitable business niche, your competitors will come after you. Our hero, Warren Buffett, likes companies that make a lot of money, but he hates it when other companies steal these profits. Buffett says that a moat around a company's castle is the most important thing to consider when investing in the stock market. He also doesn't want tiny ponds. These moats should be as broad as possible. In this video, you'll learn how to identify companies that can remain profitable in the long run, perhaps one of the most important skills that a value investor can possess. Make sure you hit that notification bell so you won't miss informative content like this. Let's start. What is a moat? Here's one more metaphor, in case you haven't had enough. It's similar to having an extraordinarily gorgeous partner to have an exceptionally successful business. You are aware that competition will exist for such products. You'll need to have a long-lasting advantage over your competitors to keep your position in both cases. That's a lot. But let's break it down, since this is exactly what Warren Buffett means when he talks about a moat. Wikipedia says that a competitive business advantage helps a company do better than its competitors. Overperformance typically entails higher profitability, a higher return on capital, and/or a significant market share. You should be compared to competitors in the same industry and enterprises. You can utilize a financial data supplier like TIKR and look at past statistics to find a competitive advantage. This is the dark art of investing, which makes it such that the best investors are only sometimes academics with exceptional mathematical abilities. It is challenging to quantify how long a moat will last. Buffett previously mentioned replacing Coca-Cola as the leading soft drink producer, but only with $100 billion. He comes to the same conclusion. It is impossible. It has a wide moat when it is difficult to overthrow a company with $100 billion. The business makes $7 to $10 billion per year. Entrepreneurs who understand expected value will only try to compete in these situations, and those who try anyway will pay the price. But remember that addressing this query is more of an art than a science. You may learn the art the quickest by looking at a few of Warren Buffett's most significant investments. The business moats of Berkshire Hathaway. You can tell a company has a moat if you put yourself in the position of one of its customers. Here are a few examples that I'll go over. Coca-Cola has been the dominant soft drink globally for a very long time. Every day, beverages made by the Coca-Cola Company are consumed by an average 2 billion servings. Additionally, it hasn't sacrificed profitability to gain this market penetration. So, what is it about Coke that is so unique? Warren Buffett collectively refers to Coca-Cola's moat as share of mind. He is saying that Coca-Cola brand name has positive connotations in the eyes of billions worldwide. They presumably associate it with refreshment, pleasure, or something similar. Additionally, a Coke is always within reach for customers who want to feel revitalized because of the company's outstanding distribution network, which also serves as a moat. Finally, the corporation wants its customers to keep drinking Coke. Therefore, they should always be free to switch to another beverage, like the Swedish Cuba Cola, just because there isn't a Coke store nearby. Because of these things, Coke has had a sustainable competitive advantage that will still be there in 20 or 30 years. Apple, which is Buffett's largest public investment, is another company with a large moat. Similar to Coke, it has a firm brand name and a high share of mind. But there are two additional factors that I'd like to draw attention to. The first is that network effects for Apple are significant. This implies that the Apple community becomes more valuable as more people join it. More app developers desire to create apps for the App Store as more people use iPhones, and this cycle continues as more people use iPhones. Then there are the effects of the technical lock-in. Even though it might not be as important as other things, I always need help using an Android-powered phone. I can't be bothered moving, even if Samsung costs $200 less than an iPhone. Not only would I have to relearn how to use the phone, but I'd also likely run into some issues when transferring my data. So, I'll keep purchasing iPhones for the foreseeable future as well. One of the two reasonably big railroad firms in North America, BNSF, is here too. There are few choices in this area if your business wants to transport heavy loads over long distances and you care about the expense of transportation. Why? Because constructing a railway network akin to BNSF's would require enormous amounts of money, time, and confirmation from local authorities. A second railroad isn't simply built adjacent to the original one. There must be more room for that in many circumstances. As a result, it will take a lot of work to replace BNSF's successful operations. The third most significant investment Warren Buffett has ever made is See's Candy. He invested over 40% of his net worth in this luxury chocolate company in the 1970s in exchange for a 100% ownership stake. That was a sizable wager, and it was successful. Like Coke, See's has a mindshare advantage, albeit only regionally in California. However, there is one more benefit that differs significantly from Coke's. Its high-quality chocolate is only purchased on rare occasions. So, will you save $10 by choosing the new, less expensive choice when you buy quality chocolate once a year for your loved ones, such as for Valentine's Day? Ah, those 3 magical letters that every girl longs to hear. The second largest auto insurer in the United States, Geico, is Warren Buffett's best performing investment overall. I believe it's fair to say that Berkshire has practically amassed a 1,000-bagger from the 33% interest in the business that he bought between 1976 and 1980. In any case, Geico has a long-term competitive advantage because it is the cheaper option in the market, where customers place a high value on price and auto insurance is a significant expense in most households. Therefore, it is advantageous to create commodities at a low price. Also, this benefit should last long because Geico is becoming more cost-effective as it grows. All moats are not created equal. Easy come, easy go. You'll likely notice a recurring trend if you look at a business we just highlighted. They've played the game for some time. In December 2020, the FTC sued Facebook for illegal monopolization. They said Facebook had been too dominant in the social media market for too long. Of course, the strongest moat one can have is a monopoly. But in hindsight, it's fair to argue that such concerns were a little out of the ordinary. The question of who will remain the dominant force in social media is still up in the air, given how quickly a firm like TikTok rose to prominence. Facebook does hold a significant market share, but if I had to place a wager on which company I thought would be more dominant in the social media space in 30 years, Coke or Meta, I'd put my money on Coke. And it appears that Warren Buffett holds a similar view based on his investment choices. The operations of Coke, BNSF, See's Candy, and Geico have mostly stayed the same in the past century. You can't always argue that longer is always better, because true success has only recently emerged for some companies, such as Apple, but it's still a strong generalization. Wise investors should no longer follow the latest trends. Old is gold. Finding businesses with moats quickly. You might be wondering where to begin at this point. What area should I visit to search for moats? I already mentioned how challenging it is to evaluate the sustainable component. You recently learned a few tips and tricks on how to help you do it, but you still need to know a lot about business and the industry. However, it's easy to determine whether a company currently has a competitive advantage, and this is a great place to start. As Warren Buffett said, we tend to judge by the past record. By and large, if the thing has a lousy past record and a bright future, we're going to miss the opportunity. Thanks for sticking out till the end of the video. Don't forget to like, subscribe, and tell us what you think about the video down in the comments. Thanks for watching, and we'll see you in the next one.